once again. Much appreciated, ladies and gentlemen. Let me just see if I can get the share screen going here properly. Today we're going to talk about finding the right financial planner or advisor. And I know that this is a topic that a number of you have raised with me. How do you go about it? What type of person is the right type? So we're going to spend some time going through this and going through the different types of financial planners and advisors out there to help you decide which is right for you. The usual disclaimer, nothing in this presentation should be considered as advice or recommendations. The author has no opinion as to the future direction of the stock markets. Particularly today, I have no clue what's going on in the stock markets. Interesting, just as an aside, that the Dow Jones hit a record high yesterday, despite the fact that the United States is in the real grips of this epidemic. Remind people that all investing involves risk and that readers should seek the advice of a registered financial or investment advisor or conduct their own due diligence. I want to acknowledge briefly NAFR Ottawa, Linda Barber, our illustrious director, Sarah Campbell, our intern for organizing and sponsoring the webinars, Michael Patnode of the Ottawa Share Club, who helps me put together the graphs, Frank Schilder, who's the master behind the scene, who operates Zoom Master, and Alan Corriveau, who's the board of directors member and who acts as hosts on each of these. To start, I just want to remind you that when you're going out into the investing world, it really is a bit of a jungle out there today. And these lyrics from the 1987 Guns N' Roses song I thought were apropos. So just to recall, welcome to the jungle. It gets worse here every day. Learn to live like an animal in the jungle where we play. If you got hunger for what you see, you'll take it eventually. You can have anything you want, but you better not take it from me. And the reason I raise this is that, quite frankly, if you don't have an arrangement with a fee-based advisor that's with a written contract, then it is likely that you are not getting the best advice. There are other ways of getting advice, but the only one that you can be absolutely certain is going to be working in your best interest is with a fee-based advisor with a fiduciary written responsibility to you. Can't underline this enough, and we will go through this in detail. So there's 6 main types of advisors and planners. And part of the problem is that the title advisor planner is used interchangeably, and there doesn't seem to be any really clear definition. But let's run through them. So there's the traditional commission-based brokers, which a few years ago was the main way people invested. They're becoming less and less, simply because there's too many built-in conflicts. For a commission-based broker to make money, she has to sell you stuff and keep selling you stuff. And if they don't make money in many cases. So there's a built-in conflict there that isn't necessarily in people's best interest. An awful lot of you watching this probably are using advisors from your bank branch. And we'll go through them, but they have a lot of limitations. There's fee-based advisors now at the big brokerages like Nesbitt Burns, Scotia McLeod, RBC Dominion Securities. What's happened over the last number of years is that these people who started off as commission-based brokers have moved to fee-based, which is, at least in theory, a better way of doing things. There are also a number of independent firms, both large and small, that offer fee-based advice. And the nice thing about them, of course, is that they're not beholden to any particular institution and its own products, its own investment products. We're also going to talk about online fee-based advisors, also known as robo-advisors, who have come on the scene in the last few years. And finally, I want to remind people about the all-in-one exchange traded funds, which, although they're not advisors, in some cases offer a good alternative to a fee-based advisor for those people with fairly simple long-term investment goals. So we wanted to start off with some poll questions. Here's poll question number 1 that we'd like to get your input on. So my advisor is one, traditional commission-based, big bank, big brokerage, fee-based, independent fee-based, online fee-based, do it myself, or don't have an advisor yet. And I can't see, but is that, yeah, there we go. So there's the question. Take a few seconds to vote, please. Okay, I think most of you who are going to vote have voted. So about 27% of you are doing it yourself. 15% are with a traditional commission-based advisor, 20% with a big bank advisor, and 20% with a big broker fee-based. So that's about what you would expect to see. A lot of people with traditional commission-based or with big bank branch advisors. So let's talk about some of the mistakes that people make in choosing an investment advisor or planner. And remember, I use the terms interchangeably. So mistake number 1 is hiring an advisor who is not a fiduciary. What's a fiduciary? A fiduciary is simply a person who has a legal, written responsibility to do what is in your best interest. And while you would think that this would be the case with anybody giving out investment advice, unfortunately, it is not. And even if you have some fee-based relationships, not all of them are necessarily fiduciary. So a fiduciary, for example, is a lawyer is a fiduciary, an accountant is a fiduciary, even a medical doctor acts as a fiduciary. They are trying to act in your best interest. And I would strongly advise that your number 1 requirement in selecting an advisor is that they are a fiduciary and that it is in writing that they are a fiduciary. The second mistake is hiring the first advisor you meet. It's really important to go out, talk to a few people, and really get to understand the differences. Third mistake is choosing an advisor who doesn't understand retirees' needs. To be blunt, it's an awful lot easier to accumulate investments and hopefully wealth than to spend it. And most of us need advisors who understand the strategies to spend it. And a lot of that has to do with taxes. And I'm always amazed at the number of advisors, particularly bank or other advisors, who frankly don't understand how the tax system works. And that's terribly important when you are spending money as a retiree. Another mistake is not asking about credentials. There's really only one credential in Canada at the moment, which is the Certified Financial Planner, or CFP credential, that is generally accepted. There are other credentials that people use, such as CFA, Certified Financial Analyst. They're not really trained to be financial planners and advisors. I know from myself, having taken the CFP courses, they are very in-depth. They take a lot of time. It took me 3 years going to college 1 night a week for 3 years to get my CFP courses passed. The other thing is, I'm surprised that a lot of people don't understand how their advisors are paid, or they're paying too much. For example, a recent survey showed that 50% of Canadian investors think that they are paying no fees. That's simply not the case. Everybody pays fees. 100% are paying fees. Otherwise, these banks wouldn't be operating, or the investment companies wouldn't be operating. But a lot of the fees are hidden or not particularly made clear. The last mistake that people make is hiring somebody who knows what the markets will do in the future. And I know any of you who followed this series of webinars know that I've been harping on the fact that nobody knows what's going to be happening in the future. And if you talk to somebody and they assure you that they've got a good idea what the markets are going to be doing in the future, I suggest you run quickly in the opposite direction. The other thing I want to mention to you is that today in Ontario, anybody can call themselves a financial planner or advisor. Believe it or not, there is no regulation yet. They've been talking about it and talking about it. They finally came out with some draft regulations this summer. And of course, there's all sorts of yelling and screaming from different people. For example, even the certified life underwriters want to be able to call themselves financial planners, despite the fact that they may have no training in the area. So you've got to be very careful about what people are calling themselves. Again, only people with the CFP have passed a rigorous series of courses and have had a number of years of experience working in the industry before they get to be called CFP. And CFP requires that all of its members act as fiduciaries. Quebec, by the way, regulates things much more than Ontario, and it regulates who can be called a financial advisor or advisor. And that probably goes back to some of the scandals that occurred in Quebec about 10 years ago, when a particularly well-known person set himself up as a financial advisor and in fact didn't bother investing the money, just spent it. So poll question number 2, I pay my advisor more than 2% per year, 1 to 2% per year, less than 1%, 0, commissions only, not sure how much, don't have an advisor. Please vote now. Okay, I think everyone has voted, who's going to. So you can see that 34% are paying 1 to 2% per year. 16% are paying less than 1%. 1% are paying 0. 4 people are commission only. 9 people are not sure how much they're paying. And quite a number of you don't have an advisor. So the 1 to 2% a year band is typical. One of the things that we discover is that the sort of turning point for fee-based advisors is about $500,000 for the big firms and about $150,000 in assets for the smaller firms. So in many cases, what you pay is based on the size of your account. Because frankly, I don't think it takes an awful lot more work to manage $1 million account as a, say, a $500,000 account or even a $200,000 account. But the fees do vary. And the fees tend to be for fee-based say if $500,000 is the average, about 1% plus or minus. Anyway, interesting to see that there's still a number of people who aren't sure how much they are paying, and that's not atypical. One thing I want to point out to you is that in a low return environment, fees really, really matter. The pundits that we read are telling us that we can expect total returns before fees over the coming number of years of 4 to 5% per year. That's because interest rates are so low, and it's because, frankly, stock markets are relatively high. So if you're paying 2% fees, you can see the dark blue line over 10, 15, 20 years is considerably less than the gold line at 0.5% and the red line at 1%. And then you can see that over a period of time, starting with $100,000, 5% annual growth, that difference can be $80,000 just in fees. The other thing I want to tell you is that 95% of financial advisors cannot beat the markets. They simply can't, and the research proves this over and over again. I was talking to a person not too long ago saying that she was signing up with a fee-based advisor, but that advisory firm didn't want to use index ETFs. They said that they picked their own stocks, and they did so because they thought they could beat the market. I thought after I spoke to her, I should have suggested what I call the VBAL test. Now, you may recall VBAL is the Vanguard Balanced All-in-One ETF. And what I should have said was, look, go to your advisor and say, I'll make you a deal. For every dollar by which you beat the total return on VBAL, I'll pay you 20%. Because VBAL would be my default. That's where I would default to. So I'll give you 20% of everything by which you beat VBAL. But if you don't beat VBAL, you get nothing. So how many do you think would take that offer? I suspect that all of a sudden their great enthusiasm for beating the market would disappear. The other thing I want to just mention is that if you're a conservative investor and you're investing in GICs, you can't afford to pay 1% fees. I mean, GICs today, you're lucky to get 2% on a 5-year GIC. 1% fee, you're left with 1%. If it's in a, say, a RSP or RIF, once you take it out of there, you're going to lose another 30% of that. With inflation, you basically have nothing. So you have to be very concerned about the fees that you're paying in a low return environment. So let's talk about some of the specifics. Traditional commission-based, they're required to pass the Canadian Securities course, which teaches a lot about securities, but nothing about financial planning. Typical fees are 1% of each trade, plus trailing fees for any mutual funds that they sell. So a lot of people aren't aware that in a typical Canadian mutual fund, which charges 2% or more fees, half of that goes to the person who sold you the fees every year, forever, for the life of the time that you hold that mutual fund, whether they do anything ever again or not. It also is potential for conflict of interest because in some cases, people have been shown to be selling mutual funds with very high fees because it paid them a higher trailing commission. I remember I had this experience myself. I was investing in a fund called Century, I think it was Canadian Income Fund, and it was doing very well for a number of years. And I kept checking it. It was beating the index. I said, okay, that's good. But then it stopped beating the index and the performance got very bad. And I didn't know much about this stuff at the time. So I took a deeper look at it, and I found out that the Century was paying extremely high trailing commissions to the people selling the mutual fund. and therefore they were charging me very high fees. So they were charging fees that were over 2.5%, and they were paying the person who sold me the fund 1.25%. So these people were motivated to sell the Century Fund regardless of its performance. As I mentioned to you earlier, 50% of Canadian investors think they pay no fees for mutual funds. And the fact is, they do. So poll question number 3, a commission-based advisor has a fiduciary responsibility to do what's in the client's best interest, a responsibility to recommend investments that are suitable for your customer, about the same level of legal responsibility as a real estate salesperson. Please take a few seconds and vote now. Okay, I think everyone has voted. So this is a bit of a trick question. The answer is 2 and 3. They have about the same legal responsibilities as a real estate agent. I could have been mean and said used car salesman, but I didn't. And 2, they have a responsibility to recommend investments that are suitable for the customer. It's called Know Your Customer. Notice it says customer, not client, customer. So supposedly suitable for the customer, but without regard to what fees are involved. And they do not. A commission-based advisor does not have a fiduciary responsibility unless that is specifically agreed in writing with the client. In most cases, it's not. Let's talk about big bank branch advisors. They have to do about 150 to 200 hours of training, or it takes about 5 weeks. But here's the kicker. They're licensed to sell mutual funds only. They cannot sell exchange traded funds, and they cannot sell individual stocks. So they sell you mutual funds. But more than that, they tend to sell mutual funds that their own bank sells. And they will promote those in many different ways and assure you in many different ways that their performance is, of course, market beating. But in fact, as we know from research, and as I mentioned earlier, 95% of Canadian managed mutual funds underperform the index, the market, over a period of 5 to 10 years. So the problem with big bank branch advisors, just to reiterate, they are limited to selling mutual funds, and they tend to be rewarded for selling the mutual funds of that particular bank or institution. Big broker fee-based, it can be an annual fee-based, sliding scale, as we've talked about, depending on portfolio size, typically between 0.75 and 1.5%. As I mentioned earlier, I think $1 million portfolio takes the same work as 100,000. So there should be a significant reduction in fees. The other thing I find interesting is that everyone today is doing wealth management. It's all wealth management sections or manager of wealth management. But I always wonder whose wealth. And I'm wondering if it's mine. There is a benefit here to these folks though, and probably the main benefit is to keep the clients from doing dumb things. And that's one of the risks of being a do-it-yourself investor, as I am, is stopping myself from doing dumb things. Independent fee-based, no conflicts, no trailing commissions, usually a fiduciary responsibility. should be a certified financial planner designation. Again, the fees depend on portfolio size, but plus or minus 1%. Can also be hired by the hour for do-it-yourselfers who want to review their portfolio or have a strategic plan developed for their portfolio that they can go and implement themselves. A couple of examples in Ottawa, companies that I happen to know, these are not recommendations. PWL Capital is a fee-based index-only investment management firm, and Ryan Lamontagne is a similar type of firm, again, fee-based here in Ottawa. For a list of independent fee-based advisors, go to this website. It's called valueofsimple.ca. Click on links, directory of fee-based, and they allow people to go on and list themselves on this directory. And it's a directory of fee-based advisors across the country. Talk a little bit about online fee-based or robo-advisors. Why would you use them? Fees are often lower, depending on the portfolio value. What happens is that you go online, you fill out a form, indicate, your age or stage, what you need to do or want to do with your investments, and they develop a portfolio based on that using computer algorithms. They're more designed for asset accumulation than decumulation. They mainly use index ETFs. And again, just to give you some examples, Wealthsimple is the largest in the country at the moment. The fees for a 100K portfolio, you can see is 0.52. Quest Wealth is part of the Quest Trade online brokerage company. Their fee is 0.38. And BMO offers a smartfolio, and it's a group with which NAFR has a discount program that brings the fee down to about 0.8. So these are some examples of robo-advisors. And again, the robo-advisors, if you've got a fairly simple investment account, primarily aimed at accumulating assets over time, they can be a very good option. Lastly, I want to mention once again the all-in-one exchange traded funds. Again, for a simple asset accumulation approach, typically there's 3 to 5 different portfolio choices, ranging from all stocks to almost all bonds and everything in between. They provide no advice. They're best bought online through an online brokerage. The fees are 1/4 to 1/8 of mutual funds. The all-in-ones are professionally managed on behalf of do-it-yourself investors. So once you buy it, it's lock and load. You're done. You don't have to do anything. And I give you some examples here. The 3 main companies in Canada offering these are Vanguard, iShares, and BMO. VBAL is a balanced 60-40, 60% stocks, 40% bonds. VGROW is 80% stocks, 20% bonds, and VCNS is 60% bonds, 40% stocks, so more conservative. And iShares and BMO have similar products. And you can see the total MER on these, and this includes all the underlying ETFs that they manage, because these are all basically funds of funds. But you can see the total expenses are in the area of 0.2 to 0.25. So pretty reasonable for something where, frankly, you don't have to do any work or worry about it. So let's do poll question number 4. I feel that I have made the right investing decisions at least 75% of the time, between 50 and 75% of the time, between 25 and 50% of the time, less than 25%, or I don't make investment decisions. Okay, I think everyone's voted. So 15% say that they make the right investing decisions about 75% of the time, or at least. By the way, most professional investment managers claim that if they make the right decisions 70% of the time, they feel they're doing well. Between 50 and 75 is 41%. Between 25 and 50, 20%. Less than 25% of the time. Obviously, these are people who are concerned and probably should get a good fee-based advisor. And the same with the last group. Personally, I hope I make the right decisions between 50 and 75% of the time, but more and more I'm learning that the best thing to do is stop making decisions once you've got your portfolio set up and just leave it alone. And that comes to this point, great saying that an investment portfolio is like a bar of soap. The more you handle it, the smaller it gets. And I wish I would learn that lesson myself. You know, one of the best things about doing these webinars is that it makes me think about stuff and stops me from doing dumb things, like continually fiddling with my investment portfolio. You know, once you get it set up, hopefully you've gone through a good process of thinking about it. And unless things change dramatically, you're probably better off just leaving it alone. Getting to the end here, here's 4 potentially embarrassing questions to ask your advisor or advisor if you haven't already. So how much did I pay last year in fees in total? I mean, what was the total fees, including MERs on any ETFs or mutual funds that I own and pay you? And then this is what I call the VBAL question. Remember, VBAL is the balanced ETF. It returned about 6.5% over the last 12 months, total return, including dividends. And that's a good benchmark. So how did my portfolio performance compare to VBAL after fees? You know, and if the answer is that it's performing less than VBAL, then you really have to wonder what you're paying for. Another question that I find a lot of investment advisors, financial planners don't think about enough is how do I meet my minimum RIF withdrawals, if you have a RIF, without depleting my principal? At 71, 72 years old, you've got to withdraw 5.2% of your RIF, and that increases every year. How do you generate 5.2% in a year when interest rates are at rock bottom? And then finally, if you have a taxable account, and again, it's an area that I find a lot of financial planners and advisors haven't really looked into, but what are you doing to optimize my after-tax income in a taxable account? And if you remember from earlier webinars, Canadian dividends, anybody earning under about $78,000 a year taxable income, Canadian dividends, the tax rate is about 1/3 or less of what it is on interest income. And you need to take that into account in planning your portfolio, and that's something that a financial planner should be doing. The other thing, I found an interesting article the other day by Ben Carlson, 3 stages of growth of a successful investor. Stage 1 was, I know everything when I'm first starting. That seems to be what's happening with a lot of people buying into Shopify or Bitcoin or whatever it might be at the moment. Stage 2 is, I know nothing after being burned a few times. And then stage 3 is, I know what I don't know after realizing how difficult it is to understand the markets. And I hope that I'm in stage 3 by now. But it took me a lot of time and a lot of getting burned to get to stage 3. I also want to underline that there's absolutely nothing wrong with paying for professional, unbiased financial advice. It will likely return the investment in a few years. And just briefly, story of some neighbors of mine in their 80s sold their house for $800,000 and were going to rent an apartment. And they had no clue what to do with their money. And they came to me and said, what should we do? And I gave them names of a few fee-based advisors to go to. And they did, and they chose one. And then about a month or so ago, they asked me to look at their financial statement because they didn't understand it. They weren't sure if they were making money or losing money or what. And so I took a look at it for them. And what I saw was that they were getting a monthly payout to cover their rent, which is what they wanted. And partly because of serendipity, when they had sold their house in mid-March this year, it got timed perfectly for them. So their money went in as the market tanked. And they were actually, I was pleased to be able to tell them, up about 10% on their original principal, despite having taken out the rent for their apartment for the last 6 months. So they were extremely pleased. And again, I just underline the point, if you need professional advice, unbiased financial advice, it's well worth paying for the right people. Just make sure it's a certified financial planner. A few select symbols and acronyms just to remind people, because sometimes people ask. RIF is Retirement Income Fund. ETF is Exchange Traded Fund. VBAL and all we've talked about. Trailing fees is the percent paid by mutual funds to whoever sold you the mutual funds, typically in the range of 1% per year. And a robo-advisor is an online fee-based advisor. I also want to mention the webinars that we're going to hold in 2021, and also mention that if you have any suggestions for webinars or questions, send it to me at investingforretirees@gmail.com. But here's some of the topics we're going to delve into: how to maximize after-tax investment income in a taxable account, the bucket plan investment strategy, not the bucket list, but the bucket plan, the 3 buckets: now money, medium-term money, future money. How to find safer, relatively safer investments that offer some reasonable returns. With GICs paying 1.7% before tax, you ain't going to get rich, that's for sure. How to invest in real estate without fixing broken toilets. That's Alain and Linda's favorite topic. And how to educate your kids or your grandkids to be better investors than we were, because they're likely going to need it, because a lot of them are not going to have access to the kinds of pension plans that we have. So with that, I'll stop and turn it back to Alain for